You see, there's a way to make $1,000 a day even when the market crashes? And even if it doesn't crash, you can still walk away with profits. Hey investors, today we're talking about long puts, one of the simplest, most powerful ways to protect your portfolio and potentially cash in when stocks fall. By the end of this video, you'll know exactly what a long put is, why it works, and how to use it step by step using Microsoft as our example. Let's break it down. A long put is like insurance on a stock you don't even need to own. Here's the thing, you pay a small fee, called the premium, and in return you get the right to sell 100 shares at a fixed price, the strike, before a certain date. If the stock falls below that strike, your put gains value. If it stays flat or goes up, worst case you lose only the premium you paid. No margin calls, no surprise losses. Let's take Microsoft, MSFT, as our example. Suppose Microsoft is trading at $350 today. You buy one MSFT 350 strike put expiring in 1 month for a premium of $5 per share, or $500 total. Now imagine a sudden tech sell-off drives MSFT down to $320. Your put is worth at least $30 per share, because you can still sell at $350. So your contract jumps to about $3,000. You subtract your $500 cost and you've pocketed $2,500, all from one. Here's the thing, markets don't slide gently. They crash hard and fast. Think back for a second. In early 2020, the S&P 500 sank about 30% in barely a month. Fast forward to 2022, the Fed slams rates higher, and the Nasdaq gives up roughly a third from peak to trough. And the gut punch moment? Meta loses about a quarter of its value in a single day after earnings. Those aren't gentle dips you can wait out. They're sudden air pockets. If you were only holding stocks, you either sold near the bottom or watched your portfolio bleed. Let's break down why that matters for long puts. When the screen goes red and fear spikes, most investors mash the sell button just to stop the pain. And that locks in losses. Emotions hijack the plan, and you end up out of the market right before the rebound. Long puts flip that script. Think of a long put as your crash ticket. You pay a small, known fee up front, and in return you keep the right to sell at a fixed price even if everything's melting. Put it on Microsoft so it's concrete. Before the chaos, MSFT is at $350. You grab a $350 put for $5, so $500 total. That's the most you can lose. Then, the sell-off hits, and MSFT slides to $280. Your put is now worth at least the difference, $70 per share. About $7,000 for the contract. Subtract your $500 cost, and you're up roughly $6,500. While others are dumping shares at $280, you're getting paid because you prepared. What this really means is fear becomes your ally. Crashes come with volatility surges, and that's exactly when long puts can rocket in value. The profits can cushion losses elsewhere, or stand alone as a payday that turns a bad tape into a good day. So the next time headlines scream "market crash," you don't have to join the stampede. With a well-timed long put on Microsoft or any volatile name, you can step aside from the damage, or better yet, harvest it. Here's the thing. A long put can turn a small risk into a big payoff. Let's break it down super simply. If Microsoft falls from $350 to $320, about 9%, a put you bought for $500 can be sold for about $3,000. After your cost, that's roughly $2,500 profit, about 500%. If Microsoft doesn't drop and just moves sideways, the most you can lose is the $500 you paid. Small known risk, big possible upside.